Institutions are increasingly converging around three themes they believe will define the next phase of digital markets: stablecoins, tokenization, and artificial intelligence. What's interesting is not these sectors individually, but how tightly they are beginning to merge. AI systems cannot hold bank accounts. They cannot sign legal documents. They cannot interact with traditional financial infrastructure on their own. But they can interact with blockchains. AI agents can hold stablecoins. They can transact with tokenized assets. They can operate through smart contracts without permission, intermediaries, or downtime. As centralized AI infrastructure becomes more expensive, more regulated, and more constrained, decentralized crypto networks are quietly positioning themselves as the financial and computational layer for autonomous software. So the real question for 2026 isn't whether AI and crypto will intersect. The question is, who actually benefits from that convergence? This is Web3 Verse. Before we begin, this content is for educational purposes only. Nothing you're about to hear should be interpreted as financial or investment advice. Now let's start with the foundation. Over the last few years, AI has evolved from simple pattern recognition into something far more powerful: agentic AI. These are autonomous systems capable of observing, reasoning, deciding, and acting with minimal human intervention. In traditional finance, AI has already been deployed at scale. High-frequency trading firms rely on algorithms that analyze vast data sets and execute trades in milliseconds. Portfolio optimization, risk modeling, and market surveillance are increasingly automated. But traditional finance was never designed for autonomous software. Legacy systems are built around humans, legal identities, and centralized institutions. AI cannot complete KYC. It cannot open a bank account. It cannot independently own assets or move capital without a human wrapper. This is where crypto changes the equation. Blockchains offer programmable money, global settlement, and permissionless access. Through smart contracts, AI agents can transact, allocate capital, and execute strategies without relying on human intermediaries. In other words, crypto provides the native environment AI needs to operate economically. This unlocks entirely new use cases. AI agents can manage treasuries, rebalance portfolios, execute complex trading strategies, and interact with decentralized protocols around the clock. Unlike humans, they don't sleep, panic, or hesitate. They operate purely on logic, probabilities, and predefined objectives. More recently, AI agents have begun interacting with each other economically. With the rise of micropayment protocols and on-chain payment rails, autonomous software can now pay other autonomous software for data, services, or computation. This opens the door to a machine-to-machine economy, a digital marketplace where value flows without human friction. At the same time, AI agents are being deployed beyond trading. They are beginning to play roles in DAO governance, protocol management, and real-world asset tokenization. By ingesting real-time market data, AI systems can streamline compliance, monitor liquidity, and automate settlement for tokenized stocks, treasuries, commodities, and even real estate. These assets can trade on-chain 24/7, without brokers, without market hours, and without geographic restrictions. For individuals, AI is increasingly being used as a portfolio management layer. An AI agent can monitor allocations, assess risk exposure, and rebalance assets automatically. If one sector grows beyond its target weight, the agent can reduce exposure and redeploy capital elsewhere, all without emotional bias. It's no surprise that adoption is accelerating. Surveys consistently show that a large majority of investors are open to letting AI manage at least a portion of their portfolios. As models improve, that trust is likely to grow. But this is where we need to slow down. Because AI agents are not infallible. They can misinterpret signals. They can fail to detect manipulation. They can over-optimize flawed strategies. In crypto, these risks are amplified. AI systems can repeatedly buy into assets that are being artificially propped up or quietly drained. They can over-automate trades, causing small errors to cascade into large losses. And like all AI systems, they are vulnerable to hallucinations, confidently acting on incorrect or incomplete data. There is also the issue of predictability. AI agents follow deterministic logic. This makes them highly efficient but also highly exploitable. In decentralized markets, predictable behavior can be targeted through mechanisms like MEV, where transactions are reordered or sandwiched for profit. And of course, there's the most obvious concern: custody. Granting autonomous software direct access to private keys introduces an entirely new attack surface. Bugs, compromised integrations, or interactions with faulty smart contracts can lead to irreversible losses. So if the risks are this high, why pursue decentralized AI at all? The answer lies in infrastructure. Most mainstream AI today is built on centralized cloud platforms. Training, storage, and inference rely on a small number of providers. This creates single points of failure, rising costs, and increasing geopolitical risk. Building and operating large-scale AI data centers is extraordinarily expensive. Hardware alone can cost tens or hundreds of millions of dollars. Add power, cooling, networking, and maintenance, and the economics become increasingly fragile. As AI adoption accelerates, these bottlenecks become harder to ignore. This is where crypto introduces a structural alternative. Decentralized physical infrastructure networks, often called DePIN, aggregate idle and underutilized hardware across the globe. Instead of relying on centralized data centers, computation is distributed across a network of independent nodes. This model can reduce costs, improve resilience, and scale more flexibly. It also enables verifiable computation, where work can be audited on-chain to confirm it was performed correctly. Storage follows a similar logic. Decentralized storage networks allow data to be distributed, encrypted, and verified without relying on a single provider. This is particularly important for AI systems that depend on large, diverse, and constantly evolving data sets. Which brings us to another critical issue: data quality and trust. AI models are only as good as the data they're trained on. Centralized data collection is opaque, often unconsented, and vulnerable to manipulation. Data poisoning attacks can subtly alter model behavior, introduce bias, or embed hidden vulnerabilities. In decentralized systems, data contributions can be tracked, verified, and incentivized transparently. Contributors are compensated, provenance is recorded, and suspicious inputs can be flagged publicly. This creates the possibility of more robust, auditable training pipelines, something centralized systems struggle to offer. Privacy is another major factor. Advanced cryptographic techniques like zero-knowledge proofs and confidential computation allow AI systems to process sensitive information without exposing the underlying data. This is essential for applications in finance, healthcare, and enterprise environments. There's also the long-term issue of quantum resistance. As quantum computing advances, today's cryptographic standards may eventually become obsolete. Crypto-native systems are already exploring post-quantum solutions to future-proof both financial networks and AI infrastructure. So what does all of this mean from an investment perspective? The convergence of AI and crypto creates enormous potential, but also significant systemic risk. Widespread use of AI-driven strategies could increase correlation across markets. If many systems rely on similar data and models, collective behavior can amplify volatility rather than reduce it. There is also the danger of narrative overreach. Not every AI-branded crypto project is meaningful. Many tokens exist primarily to capture speculation rather than real economic value. Without genuine utility, these assets risk becoming little more than narrative-driven trades. Regulation will play a decisive role here. AI and crypto both sit at the intersection of data, finance, and security. As regulatory frameworks mature, projects that can demonstrate compliance, transparency, and real-world usefulness will have a structural advantage. Tools like zero-knowledge proofs may allow participants to meet regulatory requirements without sacrificing privacy, enabling broader institutional adoption. Looking ahead to 2026, the likely winners of the AI crypto convergence are not flashy consumer apps or short-term trading tokens. They are the projects building core infrastructure, stablecoin payment rails for autonomous systems, tokenization platforms for real-world assets, decentralized compute and storage networks, privacy, verification, and compliance layers. These are the components AI systems actually need to operate at scale. Whether this narrative fully plays out will depend on market conditions, regulation, and capital flows. A prolonged bear market could delay adoption. But structurally, the alignment between AI and crypto is real. The bigger question is not whether they converge, but how deeply. That's what makes this one of the most important themes to watch going into 2026. This is Web3 Verse. If you want deeper analysis on where crypto, AI, and global capital are heading next, make sure you stay connected. The next phase is already forming.